So it says here that I am Andrew Logan. I remember that. I'm with Ceres. Ceres is a bit of an unusual. Oops. There we go. Bit of an unusual organization. We are a coalition of institutional investors and environmental groups. So we work on issues like climate change, also water scarcity, biodiversity, issues that are both important environmental issues, but that also have the potential to really impact the economy and shareholder value. So I'm really going to talk in my presentation today about climate change as an economic and financial issue. And really, I think really take a lot of what you heard this morning, the agricultural impacts, the health impacts, physical impacts, and translate it a little bit into kind of the language of finance and sort of how businesses and investors think about these issues. We have over 100 investor members in our network, representing about $13 trillion in assets depending on the day. We're also a network of around 75 companies that have made a commitment, kind of a long-term commitment, to improve their performance on environmental and social issues, including climate change. So they range from consumer brands like Coke to tech companies like Dell, a number of banks, and then also big industrial firms like Ford and GM. And so really essentially the heart of what Ceres does is to work with investors, the investors in our network, these kind of 103 investors, $13 trillion in assets, to encourage the companies that they own to become more, and the markets that they invest in as well, to become more environmentally and socially sustainable. And there's very good, there are very good financial reasons for them to want to do that. Investors and companies as well, see a strong link between performance on environmental issues and financial performance. And as this slide starts to lay out, there's lots of evidence to back this up, including studies out of Harvard, Yale, and elsewhere that show a strong link between environmental performance and financial performance. They show a lower cost for capital over time. And as a result of all of this, we're seeing investor interest in environmental and social issues as financial issues increasing fairly rapidly. So, while Ceres as a whole is concerned with a variety of environmental and social issues, everything from human rights to water, climate change has been a particular focus for investors. And so, about 10 years ago, we founded something called the Investor Network on Climate Risk, which, as its name suggests, is a group of investors, the 100 plus investors I mentioned before, who are specifically concerned about the impact of climate change on their financial portfolios. And this idea that climate change is a critical economic issue has gone mainstream actually relatively quickly. We started 10 years ago with 10 investors, $600 billion in assets, and investors who were sort of known for their social focus. Fast forward 10 years, we've grown assets under management by 20-fold. And I think more important than those numbers are the kinds of investors who are now really seeing climate change as a key material financial issue. So we've got big pension funds like CalPERS and CalSTRS, but also big asset managers like BlackRock and TIAA-CREF and Deutsche Bank. Even Goldman Sachs has weighed in with this quote here on the bottom, where they say that climate change is a topic that every board of directors should consider. So we've seen that in a relatively short period of time, climate change moved from something that is sort of nice to address, it's a good thing to do, to something that really is being seen as a matter of fiduciary duty. It's something that investors really have to consider. So why might that be? Why are investors really worried about the economic impacts of climate change? So this is sort of a busy slide. I would probably encourage you not to look too closely at it. But I think the point to take away here is just that there are a whole set of risks that extend across a whole set of economic sectors that investors see coming with climate change. I think physical risk, which you heard a lot about this morning, the droughts, the floods, the hurricanes, all of that is probably the most obvious. And the impact of that is obviously quite broad. It impacts everyone from insurers who are seeing higher storm costs, to agriculture companies who have to deal with drought and kind of the movement of pests. It impacts oil companies who have installations in the path of hurricanes. It impacts real estate firms and tourism. So I think the physical costs of climate change, which will be borne by a whole host of industries, are potentially quite profound and really will ripple across the economy. Regulation, whenever it does come, will create winners and losers depending on how well prepared companies are. So there's definitely financial risk and opportunity there. Liability risk, litigation risk is sort of the most speculative, but I think almost the most interesting. Swiss Re, which is kind of a big European reinsurer. So reinsurers are companies that insure insurance companies, so they really worry a lot about big risks. They came out recently and said that they see climate change as the next asbestos from a liability standpoint. And it's interesting. There are a lot of very smart lawyers, many of them who came from the asbestos litigation fights and the tobacco fights, who are now looking at climate change as sort of the next way that they can, frankly, make a lot of money for themselves, but also begin to take the cost of climate change and get the folks who they would say are responsible to have to pay for it. I guess one other key point here is that all of these risks are increasing. So the physical risks will get bigger the longer we wait to act. And the scale of regulation that we'll need will get greater the longer we wait to actually put that into action. So the risks are there. They extend across the economy, and they're getting worse. On the other hand, there certainly are opportunities for companies who are well positioned here. Whether it's companies who are developing new energy technology, whether it's insurers who have better models to help them predict risks. Those kind of companies are positioned to prosper even as others see their share price go down. So investors are not the only ones who are kind of taking aggressive action on climate change. Companies are increasingly calling for strong action as well. Ceres directs something called BICEP, which is which stands for Businesses for Innovative Climate and Energy Policy, and it's a large and growing group of largely consumer brand businesses. So everything from Kellogg's and Starbucks to the Portland Trailblazers basketball team, which always amuses me. Companies who really have committed themselves to publicly advocating for action on climate change, and are, I think, more importantly, are putting their very considerable lobbying power behind the push to actually get climate regulation passed in the U.S. and globally. And I think what's really interesting to me about this is it really turns the conventional narrative on its head. I think the story you often hear is that climate change is bad. Climate regulation is bad for the economy. It's bad for business. That we have to make these trade-offs between how much environmental protection and climate protection we can afford. And what these companies are saying, and what the investors we work with are saying, is really the opposite. It's actually the cost of inaction is what we have to worry about. Essentially the economy can only grow if we get climate change under control. And this is just sort of a sampling of the companies we work with. Every one of these companies has an interesting and different story to tell. So, investors are concerned, companies across different sectors are concerned, but insurance, which is where I spend most of my time focusing, is an area of sort of particular interest and concern. And there's a lot of reasons, some of them sort of obvious, some of them less so, for that. First, insurance is actually the world's biggest business, or the biggest industry. So it's important to investors into the economy just by its sheer size. And that's sort of surprising, I think, to a lot of folks. That the idea that insurance is bigger than the oil and gas sector, is bigger than the banking sector, bigger than travel and tourism. But this is a industry that generates $5 trillion a year in global revenue. And I think, but more important than its size, is just how central a healthy, functioning insurance system is to the health of the global economy. I mean, it allows us to take and manage risks. It allows us to make investments. You can't buy a house without property insurance, right? You can't get a mortgage. Without property insurance, health insurance, business interruption insurance, liability insurance, you can't start a new business or run one that already exists. And there's sort of increasing evidence, unfortunately, that climate change poses a sort of an existential threat to the availability and affordability of insurance in many parts of the world, including in many parts of this country, which has all sorts of implications for the economy. Capital goes where it's protected. No one is going to invest.
What's the footprint for these numbers? Is this U.S., world?
Yeah, so sorry, I didn't really introduce the slide. I was about to, but I can do it now. So these are global numbers. So I guess stepping back, we're not the only ones who are worried about the insurance sector and climate change, obviously. And what's interesting to me is a lot of the concern comes from within the industry, particularly the reinsurers, the ones who insure the insurers. And the reason they're concerned is that they see this data, right? This is data from, actually from Swiss Re. Munich Re puts out similar data. They're another big reinsurer, and this just shows kind of 40 years of global insured losses over time. And while there's a lot of noise from year to year, obviously you get a big storm, you don't get a big storm, you get an earthquake, you don't get an earthquake. The trend over time is very clear, and it certainly well outstrips inflation or any of the other sort of demographic or socioeconomic issues that also might conspire to drive up losses. So, I think the insurers, at least the reinsurers, have said they see a clear climate fingerprint in this data, and this is sort of the cost of climate change, right? Or at least some percentage of the cost of climate change, over the last couple of decades. I think what's more alarming, though, so this is sort of, this is the last 40 years of data. It's sort of a worrisome trend. I think where insurers and those who invest in them get much more worried is when they look ahead, right? So, even though, as you heard this morning, we are already seeing some of the impacts of climate change in the here and now, certainly scientists would say that, much worse is ahead, particularly if we continue on our sort of business as usual trajectory. So again, this is from Munich Re again. The charts on the left are just kind of a repeat of the data on the last slide, kind of showing where we've come from. But Munich Re then says, look, we are at a place where we might have $1 trillion a year in weather catastrophe losses, within a couple of decades, which is, it's a big number in any context, but it's a number that the insurance industry is not necessarily in a position to pay out. And as I'll get to in a second, they're increasingly taking steps to make sure that they will not have to pay that money out. So that buck will end up, being passed on to all of us. So at Lloyd's, which is a big London, UK-based insurer, I think this quote just kind of says it very well, lays out kind of very starkly what the challenge is for insurers, that they have to adapt to climate change if they're going to survive as an industry. And again, given the central role of insurance in the global economy, this should worry all of us, and it really is the urgency that drives our work with this sector. You heard this morning, so I'll kind of keep this part brief, but I think it is important to underscore that the physical impact of climate change and the things that threaten insurers aren't just about hurricanes on the coast. So those are kind of the big dollar figures that everyone always sees. You get a $20 billion hurricane. Katrina was a $60 billion event. Sandy, on the East Coast was around that same amount. So those are kind of the big numbers. But as you heard, climate change brings all sorts of other negative physical impacts, whether it's more intense hailstorms, whether it's blizzards, whether it's wildfires, whether it's some of the health impacts. It's sort of a veritable array of biblical plagues that are coming our way. I even actually saw a study recently about the impact of climate change on locust populations. So they're coming too, apparently. Anything on rivers running red with blood. So that is encouraging. But again, this is a slide where I wouldn't worry too much about the detail. This is just data from Swiss Re, where they were trying to model what are the economic impacts of climate change going to be on winter storms in different European countries. And they're high. It varies by country. You've got Europe as a whole. You've got Denmark. You've got Germany. You've got Sweden. All these different bars. But I think that the more important message to take away from this is just that insurers don't really have any place to hide from climate change. I think there was an initial sense that if insurers just could flee the Gulf Coast and the Southeast, get away from hurricanes, they would be fine. But I think they're finding that no, they're actually getting hit by floods in the Chicago area. They're getting hit by wildfires in California, huge hailstorms, lightning events in the Midwest. So it's sort of a dire outlook. At least if we don't do more to address some of the root causes of the issue. So there's risk, a risk that potentially threatens the long-term kind of viability of this biggest industry in the world. an obvious question to ask is, are insurers, at least other than some of the Europeans, worried about this in the way that we think they should be? And the answer is, more or less yes. You can see from some of the quotes here that the industry is beginning to acknowledge the risks, the impacts, the need to do something. But I think the more interesting question is, okay, they get that there's a risk. Are they doing anything about it? And unfortunately, the answer is not very much. So this slide is based on information that insurers have to actually submit every year to their regulators. So interesting, again, a very undercovered story. Insurance regulators a few years ago, whose main job is making sure the industry stays financially solvent, were worried enough about this issue that they actually now require every insurer, other than very small ones, every year to report publicly to them both how they are being impacted by climate change and what they're doing to manage those impacts. And that data is all public. It's, there's like 800 reports. They're all out there on the web. No one reads them but me. But they're fascinating. You can go through, and any insurer you want to read about, it's all in there. It's relatively, short on a company-by-company basis, long in aggregate. But Ceres does go through every year and read through all these responses and sort of grades companies on how they're managing the risks. And we sort of put companies in these 4 buckets. Companies that have, leading practices are on the far right. Companies that we, charitably describe as taking minimal steps are on the left. And as you can see, and the different colors here are just different segments of the industry. So you would imagine that property insurers are probably doing more than health insurers, who are probably doing more than life insurers. And that is kind of borne out by the data. But again, I think the key thing to take away here is that most of the industry is toward the left side of this chart, which means that they're not doing a heck of a lot. So you're in this sort of unusual situation where the industry acknowledges the risk, is worried about it, but does not seem to know what to do about it. And to the extent that insurers are taking action, mostly what they're doing is working to pass the buck onto the rest of us. So I think the main way that at least U.S. insurers have addressed climate change so far is by trying to get rid of the problem. So getting out of areas that they see as too risky, raising rates where they can, putting huge exclusions into their policies so that they don't really cover what you think they're supposed to cover, and it sort of sends a really interesting message, and I think one that again hasn't been widely reported or heard. I guess the idea that insurers, whose entire business is about kind of measuring and understanding risk, if they decided that this issue is too risky for them to take on, what does that mean for the rest of us? And I think the buck has been sort of passed to us, and we don't even really realize it yet. I think this has sort of been kind of made most explicit in a series of lawsuits that insurers have filed in the last couple of years, including in a couple of cases against their own customers. In one case, Zurich, which is one of the biggest insurers in the world, actually sued a power company called AES, which is like a kind of a southeastern power utility. AES had been sued by a village in Alaska, Kivalina, which is this sort of native village, which is on the coast, and because of rising sea levels, is having to move the entire village quite a ways inland, and it's costing some phenomenal amount of money. It's in the hundreds of millions of dollars. And the village is arguing, understandably, that they didn't cause this problem. They didn't cause sea level to rise, but someone did. And so they're suing 24 major greenhouse gas emitters, and mostly coal, electric power, oil and gas companies, basically arguing that they caused the problem. They should have to pay to fix it, or at least to move the village inland. And what Zurich said was, we don't want to defend you. Even though we sold you a liability policy which obligates us to defend you in case of these kind of lawsuits, we're not going to defend you, and we're going to sue you to kind of make that case. And their argument was interesting. They said basically insurance is for fortuitous events, things that may or may not happen, right? You don't know if your house is going to burn down, you get it insured. You don't know if you're going to have a car accident, things happen. Climate change, they said, is a foreseeable risk. It's not an accident, it's not fortuitous, and so it's not something that you actually can get insurance for. You should foresee it as a company and act to deal with it. And they won in a fairly landmark case in Virginia, which sets a really interesting precedent that basically suggests that companies are now on their own when it comes to actually managing this evolving landscape of liability. Even more aggressively, Farmers Insurance sued a whole set of cities and towns in the Chicago area. This summer, towns that have been hit back in 2013 by a whole series of record floods. And what Farmers said was, again, this was a foreseeable risk. You guys, these towns kind of knew that climate change was coming. You know that climate change was going to make flooding more common, more frequent, more severe, and you should have designed your floodwater systems to handle it. And therefore, we're having to pay out all this money as an insurer to cover these claims. You should pay us back. You should have to reimburse us for this, $150 million in costs. So, what does this all mean? And then I'll wrap up. Again, insurers are in the business of quantifying risk. Turning what is sort of an abstract set of things into a number, into a cost for all of us. And I think they're saying pretty clearly, both by their actions and by their inactions, this is a risk they're not prepared to manage, and they're going to pass it off to the rest of us. So I guess with that, I will stop and look forward to questions.